Millions of people quietly turn down raises, bonuses, and overtime because of one stubborn myth about taxes. They believe earning more money could actually leave them with less. It sounds reasonable, it feels true, and it's completely, totally false. In the next few minutes, you'll understand tax brackets better than most adults ever will. Let's fix this. This single misunderstanding might be the most expensive myth in all of personal finance because it makes people literally avoid earning more. Let's make sure that's never you again. So here's the myth in plain words. People think that if a raise bumps them into a higher tax bracket, then all of their income suddenly gets taxed at that new higher rate. If that were true, a small raise really could leave you with less money, but that's not how it works at all. Taxes are far kinder and far smarter than that. So here's what actually happens. Tax brackets are marginal. That means only the portion of your income that falls inside each bracket is taxed at that bracket's rate, not your whole income. Picture your income being poured into a series of buckets, stacked from bottom to top. Each bucket has its own tax rate, and a bucket only fills once the one below it is full. The bottom bucket has the lowest rate. As your income rises, it spills into higher buckets with higher rates, but the money in the lower buckets keeps its low rate forever. So only the very top slice of your income, the part that spills into the new bucket, pays the higher rate. The rest of your money is completely untouched by that higher rate. It's a step system, not a cliff. You gently climb stairs, paying a bit more only on the new height you reach. You never fall off an edge just for earning one more dollar. Let's walk through a simple, made-up example, since the exact numbers change every year. Say the first $11,000 you earn is taxed at 10%. Then the next chunk of your income, above that, is taxed at 12%, and a higher chunk after that at 22%, and so on, climbing in steps. Notice what this means. Even if you reach the 22% bracket, you're not paying 22% on everything. You only pay it on the dollars that actually reached that step. So what happens when a raise pushes you into a higher bracket? Only the new dollars, the ones above the line, get taxed at the higher rate. Every dollar below stays exactly the same. Which means a raise always leaves you with more money in your pocket. Always. It's mathematically impossible for a normal raise to make you poorer through tax brackets. Let me say it as clearly as I can. There's no income level where earning one more dollar through normal wages makes your total take-home pay go down. It simply cannot happen. So never ever turn down a raise, a bonus, or extra hours because you're scared of your tax bracket. That fear is costing people real money for absolutely no reason. This brings us to a key idea. Your top bracket is called your marginal rate. It's the rate on your last dollar earned, not the rate on your whole income. The rate you actually pay across all of your income is called your effective rate, and it's always lower than your top bracket, often much lower. For example, someone in the 22% bracket might actually pay an effective rate closer to 12 or 14% once you blend all of their buckets together. So when people say they're in the 22% bracket, they often pay far less than that overall. Most people dramatically overestimate how much of their income taxes actually take. This is why comparing your tax bill to a single big bracket number is so misleading. Your money is spread across several buckets, and most of it sits in the lower, cheaper ones. More good news. Not all of your income is even taxable. The standard deduction lets you earn a chunk of money completely tax-free before any brackets even begin. It's like the government handing everyone a tax-free zone at the bottom. Your brackets only start filling up after that free slice is used. Another reason your real rate is lower than you think. And you can make that taxable income even smaller. Money you put into accounts like a traditional 401k, IRA, or HSA comes out before taxes, lowering the income that gets taxed at all. So you're not just saving for the future, you're quietly dropping into lower buckets and shrinking your tax bill at the same time. The system actually rewards smart savers. A Roth account flips it. You pay the tax now, but then it grows and comes out tax-free later. Either way, simply understanding your buckets helps you decide the smartest move. Quick clarification, because people mix these up. A deduction lowers the income you get taxed on. A credit is even better. It cuts your final tax bill dollar for dollar. A $1,000 deduction might save you a couple $100. A $1,000 credit saves you a full $1,000. Credits are pure gold, so never leave them unclaimed. Now, one honest nuance. While brackets themselves never punish a raise, a few specific benefits or credits can phase out at certain income levels. These are rare and separate from brackets. For almost everyone, the rule holds rock solid. Earning more money always leaves you better off. Don't let a rare exception talk you out of a guaranteed raise. The takeaway is simple. Don't make life decisions based on a tax myth. Run the real numbers or just trust the math. Earning more, almost always, simply means keeping more. Understanding this changes how you live. You stop fearing raises, you chase bonuses and overtime, you make smarter choices about retirement accounts and how you earn your money. You also stop overestimating your taxes, which helps you budget and plan with real numbers instead of a scary guess. Knowledge here turns directly into confidence and money. So let's bring it together. Tax brackets are marginal. Only the slice of income inside each bracket pays that bracket's rate. A raise never lowers your take-home pay. Your effective rate is lower than your top bracket. The standard deduction makes part of your income tax-free, and pre-tax accounts shrink your bill even further. Taxes are friendlier than the myth. And if taxes ever feel overwhelming, remember, you don't need to memorize every rate. You just need to understand the shape of the system, which now you genuinely do. So the next time someone says a raise isn't worth it because of taxes, you'll know the truth. More income is always more money. The bracket boogeyman is simply not real. So now I want to hear from you. Did you used to believe the tax bracket myth? And has fear of taxes ever made you hesitate on more income? Tell me in the comments below. If this finally made tax brackets make sense, hit that like button, subscribe for more money lessons, and share it with someone who's scared of getting a raise.